It's Nancy from Nancy True Homes at Keller Williams NJ Metro Group. It is the third week of January, and we are starting to see a little bit of stabilization in the market. The bond yields have dropped, and so therefore mortgage rates are expected to remain and or maybe even get a little bit lower. That's always exciting. FYI, just so you guys know, the week to week, we've seen a 25% increase in purchase applications for mortgages across the country. Now, don't get too excited. The bar was so low to begin with that 25% really is not that big a deal. But at the same time, it feels like we're breathing a little life back into the market, which is very exciting. Now, just so you guys know, don't forget, in October, we had the highest interest rate that we had had so far, which was just over 7.3%. Well, we're back down to, the low sixes, and I'm really hoping that we're going to drop below 6 at least sometime in the first quarter, if not by the second quarter. So what I want to say is, Federal Reserve, you have done your job. Congratulations, you are doing great. Now, can you just land us into the Hudson, please? Do not fly us into a cliff. Let's just take the win and have our soft landing, okay? One thing I want you guys to be aware of is, while purchase applications look good and builder confidence looks good, don't get too excited, because when they publish the sales for the closings for January, February of 2023, they're going to look like crap again, because don't forget, closings now really don't reflect the market now. It's a delayed sort of thing. They reflect the market from 2, 3, sometimes even up to 6 months ago, okay? Depending on how long it's taken for those properties to go under contract and finally close. And don't forget, Q4 of 2022, I believe, was officially a poop show. So those numbers are going to be reflected in home closing data, and it's going to look like upwards of 30, 40, maybe even 45%, price drops. But I'm going to tell you right now, that is reflective of Q4. And I think that once we get through Q1 and Q2, and by the time we get to Q3 and Q4 of 2023, we're going to have a pretty healthy market, okay? But so just be aware, that is lagging market data, and it's going to look negative. But honestly, I'm kind of looking forward to it. Between Martin Luther King and mid-May is kind of the big crush of spring market for us. And so far, it's feeling really good. We are writing a lot of offers, okay? A lot of new clients coming to us. There's definitely a lot of people, calling and reaching out to find a home or possibly to list their home, which is exciting. And I'm telling you, the comps are going to be better by the middle of this year. Anyway, seasonality. That was the question, seasonality. A lot of people are going to say, well, January, February numbers from closed deals, those numbers are down. Well, they are year over year if you're comparing them to January and February of last year. Because last year we had no seasonality. Usually between December 15th and January 15th, right before the holidays through Martin Luther King weekend, that's our low season. Those 4 weeks are the lowest season we have of the year. And last year we really didn't have any seasonality effects because everybody was so desperate to get into the market. They were practically giving money, money was practically free. So if you do a year-on-year comparison, a year-over-year comparison, yeah, it's going to look really scary, we've dropped 35, 40%. But don't forget, what we see now is really reflective of, a more normal sense of seasonality. So don't let that fool you, okay? All right, that's pretty much it. I'm really hoping that we're going to see some more listings come on the market, because as we know, more listings means demand creation as opposed to less houses to look at, which result in demand destruction. So if you have any questions, you are always welcome to reach out. I can be reached at 917-992-3098. That is my cell phone. And I look forward to talking to you guys next week about the market.